$6.7 billion. That's how much one Roman emperor had to pump into the banking system to stop the largest economy on earth from collapsing. The year was 33 AD, almost 2,000 years before Lehman Brothers filed for bankruptcy. The question is, why does the mechanism behind that collapse look exactly like what's happening to your money right now? Rome didn't collapse because it ran out of money. It collapsed because it had too much credit. Private banks lent against real estate with almost no oversight. Land prices inflated for decades. Then an old law nobody cared about got enforced, and the entire system cracked in weeks. If you're carrying a mortgage, sitting on a savings account, or holding bank stocks, you need to hear what happened next. Because the chain, easy credit, real estate bubble, margin calls, bank runs, government bailout, matches 2008 step for step. And right now, at least 3 major economies are showing the exact same warning signs. Most people think banking is a modern invention. It isn't. By the 1st century, Rome had a financial network so sophisticated that economic historians have to use Wall Street terminology just to describe it. Argentarii, private bankers, took deposits, made loans, and guaranteed third-party debt. They operated right in the forum where every major transaction in the empire passed through. They didn't just lend cash, they lent against property. Land across Rome and the provinces became a speculative asset. The aristocracy borrowed to buy land. Land went up, they borrowed more. This cycle ran for decades. Mensarii, state-run banks, were supposed to provide oversight. But the line between public and private was blurry. Money flowed between both systems with almost no regulation. Then in 31 AD, Sejanus, Tiberius's right hand, was executed for treason. His assets and those of every known ally were seized overnight. Dozens of loan guarantees evaporated. Almost simultaneously, 2 things happened. The trading firm Southes & Son, according to economic historians, lost 3 cargo ships in the Red Sea. Around the same time, Malchus & Co. in Tyre went bankrupt after a workers' strike. Both owed heavily to banks on the Via Sacra, Rome's Wall Street. When they defaulted, the dominoes started falling. The law was Julius Caesar's, passed in 49 BC. The core provision, anyone lending money at interest had to hold a portion of their wealth in Italian farmland. For decades, nobody enforced it. Then, in 33 AD, the courts started prosecuting violations. Tacitus wrote that every single senator was in breach. The immediate effect? Creditors started calling in loans, not because they wanted to, but because the law forced them to free up cash for land purchases. Debtors couldn't pay. The only option? Sell land. Hundreds of sellers hit the market at the same time. Property values collapsed. Tacitus recorded the chain of events in the Annals, Book 6. Creditors demanded repayment. Debtors dumped land. Buyers disappeared. Prices cratered. Banks lost liquidity. Now let's talk money. 100 million sestertii. That's the figure Tacitus recorded in Annals 6:17. Converting that to modern dollars depends on your method. By silver weight, each sestertius contained about 2.5 grams. The bailout comes to roughly 283 million. Big, but not shocking. By labor cost equivalence, a Roman legionary earned about 900 sestertii a year, roughly comparable to the current U.S. median salary of $60,000. Then 100 million sestertii equals 6.7 billion. Sit with that number. Both numbers are estimates. The truth is somewhere in between. But either way, this was an emergency expenditure equal to roughly 0.5% to 1% of the empire's entire GDP. Rome's GDP under Tiberius is estimated at 10 to 20 billion sestertii. Tiberius didn't hand out cash, he lent it. 0 interest, 3-year term, collateral, land worth double the loan amount. This wasn't charity, this was quantitative easing. First century edition. Cash flowed back into the system. Land prices stabilized. The surviving Argentarii started lending again. The crisis ended on the surface. September 2008, Lehman Brothers filed for bankruptcy. The direct cause? Too many subprime mortgage loans, collapsing home prices, devalued collateral, cascading bank failures. The US government rolled out TARP, $700 billion. That's 4.8% of GDP. Actual disbursement, $417 billion, or 2.8%. Put them side by side. Different scale, same mechanics. Easy credit, inflated real estate, a sudden trigger that forced liquidation, fire sales, vanishing liquidity, a government bailout. Rome had Caesar's law. America had the Fed, hiking rates from 1% to 5.25% in 2 years. Different triggers, identical chain reaction. March 2023, Silicon Valley Bank. Depositors pulled $42 billion in a single day, the fastest bank run in American history. If you've got an account at a regional bank, you've asked yourself the question, is my money actually safe? That's the exact question Romans were asking in 33 AD. The answer back then was no. In 33 AD, Argentarii lost money on shipwrecks and a political purge. In 2023, SVB lost money because the Fed raised rates. Different details, same pattern. An unexpected loss, a collapse in confidence, a run on deposits, a failure. And here's the part worth thinking about. Both Rome and the US solved the crisis the same way. Inject liquidity, save the banks, let ordinary people absorb the long-term damage. Tiberius gave the aristocracy interest-free loans. The Fed bought toxic assets from Wall Street. Roman farmers lost their land. American middle-class families lost their homes. The question isn't why 2008 looks like 33 AD. The real question is, why hasn't the government playbook for a credit crisis changed in 2,000 years? Pump money in, rescue the big institutions, hope it doesn't happen again. It always happens again. Tacitus wrote the Annals roughly 83 years after the crisis. He had the records. He understood the mechanics. He documented every step. Every credit crisis in recorded history follows the same 5 steps. 1, credit expands beyond control. 2, asset prices inflate. 3, an unexpected event triggers a call on debts. 4, fire sales, liquidity collapse, bank runs. 5, the government steps in with money it doesn't have. 33 AD, all 5. 2008, all 5. 2023, all 5. The question for 2026 isn't whether it happens again. The question is which step we're on. Tiberius's bailout worked. In the short run, land prices stabilized. The Argentarii reopened. But nobody fixed the root cause. Lending stayed unregulated, speculation continued, and 3 decades later, Nero inherited an empire already cracking at the seams. Tacitus wrote that the law was enforced strictly at first, then ignored, as always. Bailouts don't fix problems. Bailouts buy time, and Rome wasted every minute of it. Run these numbers, 6.7 billion. That's the price of rescuing a broken financial system in 33 AD. 2,000 years later, the price tag was 700 billion. What's it gonna cost next time? But money doesn't just lose value in a crisis. It loses value every day. So slowly, you don't notice. A single sestertius under Tiberius could buy bread, wine, a night's lodging. Convert Roman prices to $1,000 today, and the purchasing power from 2,000 years ago is disturbingly close to what you've got in your wallet right now. If you don't want to miss that breakdown, subscribe now. Next video, what 1,000 could buy in ancient Rome versus today. Don't let the algorithm decide for you.